Welcome back to Real Estate Mindset. Good morning. Happy Friday. We have a plethora of information to go over with you guys, including the market, real estate, the economy, and obviously we're going to go over some of allegedly President Trump has essentially said he wants to replace Jerome Powell. So we're going to listen to two different candidates on who could potentially replace Jerome Powell and their stance on aggressive rate cuts. But some people think that's actually propaganda, and he's really not going to replace Jerome Powell. We have Mitch Vexler here. We're going to start out by going over the one-year return on the markets. We'll do a market update. Before I do that, I wanted to say good morning to everyone that's here. But Steven, I see you. So Steven got bamboozled. Steven's in the chat, and you guys will notice as well, I have the comments on the screen. So we will have the comments on the live. Just please don't get me like copyright strike or something, right? Like don't use any bad words because they don't like that. But your comments are right there. I wanted to show you guys that. And Steven got bamboozled. Steven, right here, Steven, he got bamboozled because he went in to fight his property taxes. He's a broker. So this is a man that is on the screen right here, Steven. And this is a man with knowledge in real estate and knowledge in how comparable data works and how appraisals worked. And he went in to fight his property tax and they completely ran over him. And the first question was, are you in Montgomery County appraisal district? Because that's where I am at, and maybe I can give you a hand, but he's all the way in North Carolina. And I'm telling you guys that to remind you that this problem with the software and central appraisal districts taking a budget, backing it into our value, it's a problem across the nation. It's not just in Texas. It is really bad in Texas, but not just here. So David, good morning. CT, good morning. Laura, there's my man. P Nice, I love you, P Nice. I always see you. Steven, I'm sorry, man. See, look at Steven's been in real estate since 1985. I'm sorry for all the stuff that you're going through, Steven. But before I really jump into the market update, and you guys continue to comment, I'm going to try to bring as many comments into the fold, into the conversation as possible. But Mitch, before I jump into a market update, you got anything for us this morning?
Well, I was watching the market. So today is a very benign day. Not much is happening, but oil is down, and it has been down for almost 2 weeks now. So that's good because that helps take some of the pressure off in terms of energy costs with regard to the household expenses for mom and pop. So as oil goes down, it's all good.
Yeah. And we got a lot of stuff, guys, including an article at the end. Someone wrote an article on a live that we did, super flattering. But let's get started right now with our market update. And I'm going to have chapters on everything that we go over so you guys can come back here. You guys could learn as well with us. So let me pull up this first thing right now. I see you muted yourself, Mitch. Very good. Very good. Because we got an echo. Mitch is refusing to wear the headphones, says Travis. When you come here to my place, we will get you set up. All right. So we're going to get him set up here shortly, but let's start with the market. And what I'm going to do after we take a look at the 10-year, I'm going to show you guys, and we're really going to focus in on the one-year return on various investments, just to give you guys a little bit more insight on how much money you could have potentially made if you believe in being part of the system. Personally, I don't, which is why I'm in metals. But here's the 10-year treasury. This thing has been, it's been whiplash. The amount of manipulation that's going on with the 10-year or longer end of the yield is absolutely crazy. But the 10-year right now is 4.3. Yesterday, you guys, pre-market, or I'm sorry, 2 days ago, when PPI came out, this was almost under 4.2, which would have caused potentially FHA mortgages to get close, if not under 6%. So we would have potentially seen 5%. We're already seeing 5% mortgage rates right now. If you're shopping your mortgage, FHA, and you have great credit and great compensating factors. So let's go into the one-year return. So we're going to start looking at the one-year return right now, guys. We're going to start with the Dow. So the Dow up a little bit this morning, 45,000, pretty crazy. So the one-year return on the Dow is 11.21%. So the stock market has been going up a bit again, but the Dow's at 11.21. Remember these numbers, you guys, because I'm going to show you again, ultimately ending with pensions to show you that if you have a pension or 401k, you're really paying a lot of fees, and it shows with your yield. Now, here's the S&P 500 at about 6,500. You see that right there. Now, the 1 year on the S&P is actually 16.44%. So if you were investing in this index, you're up about 16.44%. Look at the NASDAQ, guys. NASDAQ almost, it's under 24,000. Mitch called the 24,000, hitting 24,000, then going back down. But the NASDAQ has been on a kick, and that is up over 1 year. Pretty good amount, 22%. So NASDAQ up 22.1%. Take a look at gold. Gold today it's kind of hovering around 3,300, 3,400. Today it's at 3,385. But look at the 1-year return on gold right here. So 1-year return on gold, 33% or 32.95%. That's a nice little come up in 1 year. Wouldn't you guys agree with that? But 1 year for gold, 32%. Let's look at silver, see if silver's beating gold. So silver's at 37.83 right now. So it's down to 2% right now, whopping 2%. So about the same as gold, actually. So silver's up 33.13% over the last year. And what I want to show you guys as well, not that I believe in it, I'm not investing in crypto. Okay, hold on one second. I'm not investing in crypto, but I did want to at least acknowledge the massive run up on XRP. Again, I don't have XRP. I've chosen physical metal because I don't understand enough about crypto yet. But, and I'll ask Mitch later, with what's going on with Ripple and XRP, I still don't know enough, but my God, look at the return over 1 year on XRP. 447%. So 447% come up on XRP. I mean, that's absolutely astonishing. Look at Bitcoin. Let it load real quick. Man, these things always suck at loading. Sorry about that, guys. A little bit of refresh. Oh, as soon as I hit refresh, you know what I mean? All right, so over 1 year, look at Bitcoin. So Bitcoin at 118 to 70. Bitcoin up 99% 1 year. That's absolutely crazy to me. But if you were investing, good job, because you took a gamble and it paid off so far. I don't know if you want to sell it or not, but look at the pensions, guys. This is XPS pensions. So this is not CalPERS. This is XPS pensions. And I wanted to show you, when we go back 10 years, the run up on pensions. Starting with 2015, you can see that the come up there was in 2015, 7.2%. So that's a high come up for a pension. Most pensions are only coming up 2 to 3% per year. This one's ahead of the curve. 2016, 8.8, but look at 2017, they actually lost value of about 2%. And then it goes on a string of a few years at 3%, 2%, 4%, 3%, 4%. And then recently it's jumped up to about 5.5, and in 2024, 7.97%. Now that would be a much higher come up if you guys were investing in pensions, if there wasn't as many fees and commission that took from you. So that's just a quick market update over the last year. Not sure what you guys are doing. Again, I'm only investing in metals. I've liquidated what little I had. It was a little bit, just to make that clear. In my 401k, I don't trust the system. I don't like the leverage. I don't like what the system and the leveraged up debt, the fraudulent government, horrible policies are doing to normal mom and pops that just want a peaceful life. I want a peaceful life. I don't need to be a millionaire. I just want a good life. So Mitch, question for you. What is your, I want to talk about XRP. All right. I was going to talk to you about, what we can really invest in 2025, but I mean, self-education, getting out of debt, being self-employed, physical metal. We talked about that, but could you go into XRP a little bit? Because there's been a lot of news over the last 2 weeks about XRP, Ripple, right? And things like that. Is it time to invest in crypto yet? Or are we a long way from that? In a way, I'm saying invest, but maybe we have more fundamentals. Maybe we have a little bit more knowledge. It's a safer bet. It seems a little bit inconsistent right now, although 400% come up in a year. So maybe I don't know what's going on. What is your take on XRP?
People can invest in options on futures, physical, such as physical gold, physical silver, or a hard wallet of Bitcoin. But one must understand that there's a correlation in the indexes. So when the indexes drop, the correlation of the market increases, and then all the underlyings, not all, but the vast majority of underlyings in the market will also drop. So with regard to your question about the fundamentals, what fundamentals? See, the point of the matter is, what fundamentals on Bitcoin? What fundamentals on XRP? They're not trading on fundamentals. They're not proven. They're speculative instruments. And if you're going to do a speculative instrument based on what I just went through, options, futures on options, etc., the point of the matter is you're trading. And there's nothing wrong with that as long as you know what you're doing and you understand the timing of the market. But if you think that Bitcoin has a fundamental, no, you're trading the news. And as a person who knows how to trade, you don't trade the news, you trade the reaction to the news. So you have to understand where you are in the marketplace and what you're doing. If you want to own Bitcoin as a certain percentage of your personal portfolio, no harm, no foul, amen. But own it in a wallet that's in your control. It's a hard wallet. So I think there's problems indicative of people saying, well, XRP is up 400%. Yeah. And how many people were able to ride it up? Not that many. So you have to understand, what does it really mean, and then not participate in the news. The news is the hype. The fundamentals of any of this stuff doesn't exist. Now, Ethereum, as I said, they're trying to get it to the point, they're experimenting now with hard assets, gold, underneath Ethereum. They're doing it in Dubai. Once that's proven, okay, now we've got a fundamental story. But at the moment, no, you don't. You have a hype.
Okay. Well, can we say this? I'm going to try to get you. Isn't inflation the fundamentals in this market?
Inflation is a hard fact. Yes.
It's a hard.
Yeah.
I mean, that's why, would you agree that the only reason why we're at all-time highs, and I'm going to go into inflation after the PPI video I'm about to play, is because the inflation, without the money printing, without the deficit, obviously, and without the leveraged up non-banks, we would be far off of highs. Would you agree with that?
And without the central appraisal districts committing fraud, which goes to the school districts committing bond fraud, yes, that's roughly 5.1 trillion of outstanding school district bond fraud across the United States. The combination of what you just said plus what I said proves the point that you're going to have to eliminate the fraud in order to restore the system to any resemblance of credibility.
And I wanted to say, I was looking at a post from, I think it was Epic Real Estate, because he's been covering property taxes a lot. And I was looking at the comment section just to see how close people were to understanding what our fight is and the solution. More specifically, what's the solution to property tax? And man, I can't tell you how wrong these people get it. I'm glad that they're fighting. I'm glad that they're bringing to the attention the atrocity of property taxes, but they don't understand the solution. They're still saying, well, if we don't get revenue from property taxes, we have to get it from somewhere else, and it's going to equal a 20 to 25% consumption tax. What they're not understanding is the gauntlet of fraud in the middle. There's so much fraud. There's so much servicing of the fraud, which is the ISD bond debt. You wipe away the ISD bond debt, you already are freeing up a ton of money. You wipe away all of the bureaucracy in the middle, you wipe away the budget as well. So by removing property taxes, you're also decreasing the budget. And I really hope people understand what we're saying. It's not the same budget with property taxes. I mean, when you remove property taxes, it's a completely different budget. And the way that and again, Mitch has the bill and Texas Ledge, which, to be honest with you, I feel like we're being played, Mitch. I feel like they're playing us like propaganda. Anytime someone wants a good public opinion, they just call us and ask us to speak at their town hall meeting or ask us to speak to the public. It's driving me absolutely crazy because they keep folding to repealing and abolishing property taxes. Why do you think that is?
I think one of the issues, and I destroyed him, which was Senator Betancourt, and I did it on video. And I did it with a spreadsheet, and we proved irrefutably that our math is correct. So it'd be 15% sales tax for 3 years. It'll drop to 11 or 12% upon stabilization. Senator Betancourt came out and said, well, I have this report in my hand, and this report says 26%. I don't give a damn what the senator said. I don't give a damn what the report is. I've got the math. We gave that math. It's on the video. It's underneath one of the descriptions. So the math is the math. I'm not interested in hype. I'm not interested in what Senator Betancourt has to say, who makes his living from real estate tax consulting.
Bingo.
So he's conflicted to begin with. He's got zero business paying for a report if that's what he did. And the point of the matter is, it gets picked up in the press, and the press repeats a nonsensical story. Literally nonsensical.
So that's where they got it from then. They got it from him. Is that where they got that number?
More than likely, because I just find it very interesting that this 26% keeps floating to the surface.
Yeah.
There's not a stitch of truth in it. Right. It's just simply not necessary. And there is no other solution. If there was, given all this time we've spent on this, we would have figured it out. This is the solution. This puts the equality, which is required under the U.S. Constitution and under the state of Texas Constitution. The word equality is there, meaning the law is applicable to every citizen, including the government. Nobody gets to say, well, I get to bend it this way or bend it that way, or I get to lie here or I get to lie there. It's equality. This is where the CADs are failing. And to that point, I'm spending the next 3 days getting prepared for what I believe is an upcoming meeting with the FBI, working on a document that is taking the most harsh realities and laying it out so that anybody, be it the FBI and or mom and pop out there, can follow it. We'll see what it looks like on Monday morning when I'm done. It takes an awful lot of work to make things finite and get them down into a small package, but that's going to be the irrefutable proof in terms of being able to follow the ball that everybody should be looking at, because that tells you, okay, here's how they broke the laws, here's who did it, here's the ramifications of doing it, and here's the violations of the law. So like 4 baskets, if you will, and that'll be irrefutable, just as everything else is that we've published and everything else that's on the website. I'm just trying to distill it down so that we can get there quickly.
This is a comment. This is good. And I appreciate that, because we have, we're really trying. I think we could finally get a sit down with the FBI. But think about what Mitch just said. One of the senators here in Texas that is allegedly the pioneer at repealing property taxes, Button Corp or whatever, Butterbean. Do you remember Butterbean? Anyways, we won't go there. The boxer Butterbean. Button Corp. Think about what he's saying. Button Corp has a tax protest company and makes millions of dollars from fighting property taxes. He doesn't want, and he's a senator, he doesn't want to end property taxes because he's making millions of dollars off of it, the existing system, because he gets to be a hero. They know him probably at the CAD, and the CAD gives his clients probably, if we were to compare his clients versus the clients of other tax firms, I bet we can show that Button Corp gets a higher deduction down for his clients because he's a senator. So he throws around his name. He makes millions of dollars in profit by doing that. And he's misleading information, fake news. He's saying, yeah, we can't look at ending property taxes because we need a consumption rate of 20 to 25%. What a tyrant. That's an absolute tyrant. And I will also say, again, I don't want to beat anyone up, but I'm so sick and tired of these politicians, man. I mean, we just need someone. We need someone. Now, speaking of that, look at Mike Jones. He said, that's awesome. Please tell them you need to talk to Kash Patel. And I'm going to tell you, Mike, obviously, we tried that weeks ago with a House rep that has a kind of an indirect indirect ability to get us to sit down with Kash Patel. But she's just completely ghosted us after us helping her. I won't use her name, Mitch, but if any of her people are watching, I just wanted to say that she will be held accountable for what she told us, because she is folding and she's being swept in the wind. These politicians that go in using propaganda like, we're going to repeal property taxes, we're going to abolish property taxes. What's happening is number one, they're using that to get into office. And then when they see that it's really an uphill battle, and if they go against the system, they're going to be cut, right? The funding is going to be cut. Their people will turn against them. They fold, and then they just go with the flow. And when a politician that runs based on making permanent change folds and just goes with the flow, they become the system itself. And that's what we're seeing happening, and it's really discouraging. But let me go into PPI real quick.
Just before you do, I have one other thing.
Okay, what do you got?
Here's the irrefutable bottom line that affects every single mom and pop in the United States. If you own real estate, this affects you. So the compound interest calculator, top dead center of my website under mockingbirdproperties.com/DCAD. I use Godly, Texas as the example. Not really relevant that it's godly for the sake of this conversation. What is relevant is that chart. That is the net effect of the compound interest on your property, your house, your apartment building, your retail center, and that is irrefutable. And the reason why the senators do not want to stand toe-to-toe with me is because I will use that chart as a bludgeon against them. It is irrefutable. There's one question to be asked on that chart. How exactly are you going to stop this from happening, Mr. Senator, Mr. Congressman? This is happening now. This is reality. This is the problem, and this is the fraud. That compound interest calculator proves the fraud. And we're using that as what's coming up on Monday as soon as I get all these things linked up. But that's the one question. How are you going to stop this? And the answer is you can't. There's one solution, which is to wipe out the fraud. put the school districts into bankruptcy, wipe out the 5.1 trillion of outstanding school district bond fraud. And if you don't, you, the senators, are aiding and abetting a criminal conspiracy to defraud. It's that simple. And what I hope is in my head at the moment, as soon as I get it out on paper, we're going to lead to that ultimate conclusion for the FBI. They're not getting out of this. They're caught. And it's an economic crime against humanity. If you think that the weapon of mass destruction is a nuke, well, that's kinetic. What's not kinetic and what's real is financial.
Okay. Well, I just, if you're a politician, House or Senate in Texas, shame on you. That's all I would like to say. Shame on you for using your own people that are suffering, about to be bankrupt. Some of them already bankrupt. Shame on you for playing on our emotions. Shame on you for running and lying to us and giving up. You didn't even last 1 year. Shame on you for your lies and your deceit. And you need to get out of office. I don't care how old you people think you are or how hard the job is, then don't run for office. It's as simple as that, because you're a bunch of liars and you're using what we need against us. You're just part of the system. Shame. Anyways, let's watch the first PPI video real quick so everyone's up to date on the inflation. And then we're going to go into inflation, because inflation has a direct impact on the all-time highs that we have right now. So let's listen to this first video. Man, I do not like politicians, Mitch. I do not like them. There's not a single, other than maybe the judge in Montgomery County, Texas. That guy, Mark Keogh, that guy, you guys, if you're not from Montgomery County, Texas, look up the county judge, Mark Keogh. And if you're a politician, to the politicians, that's who you should be like looking up to. That should be like what he's doing for his community, fighting for fraud, fighting against corrupt government officials, for his constituents, for his people. That guy's an absolute, I don't want to say hero, Mitch, but he's kind of my hero. He's fighting against the system. This guy's
from the politician standpoint, they get involved. And like you said, they become overwhelmed. But here's the underlying point. If their staff is overwhelmed, then get rid of your staff.
Yeah, that's not a good excuse.
To the message. And this also includes to somebody that we know is running for governor. If you do not get your messaging right, and if you do not know how to stick, you're going to lose. Governor Abbott is absolutely beatable. It's very simple. Governor Abbott, you said for multiple years you want to eliminate the property taxes. Why didn't you do it? Governor Abbott, why are you the chairman of the Bond Review Board? Governor Abbott, how much money do you get paid as being the chairman of the Bond Review Board? Governor Abbott, why is the Bond Review Board $24 billion short as compared to the Texas Education Agency with regard to roughly 32 school districts? Governor Abbott, how much money did you receive in terms of donations from the Texas Teachers Association? Thank you very much. Get off the stand. Case closed. The point of the matter is he's beatable.
Oh, look at this. Look at this.
Somebody who's got the ability just to stick to the damn message.
Yeah, I think I have someone in mind with that ability that should run for governor.
But my point is that the politicians that are in place, there's multiple people. We're not just talking about one person. There's multiple people in Texas politics, in the House, that have said we have to do this.
It needs to be you.
They're surrounded by people who cannot deliver the message. So therefore, they're folding A, under the weight of the other idiots that are around them, B, under the weight of their own staff because their staff isn't doing the job, and C, they don't have their messaging correct. You've got to finish the entirety of the message, which is repeal the real estate tax, repeal all property tax in favor of the uniform states sales tax. Finish the sentence. If you finish the sentence, you will win. It's that simple.
It's so simple. You can make it simple with research, right? Mitch, the person in mind is you. Look at, and I'm not the only one. Mitch for governor of Texas. Mitch for, it says, I'm not the one that said it. Okay. It says that. And it's a couple of people are like, oh, I'll vote for Mitch. Also, thank you, Joshua. I got to get to this video, Mitch. We're so behind. I have a meeting with Luke from Market Mania. But Joshua Chambers, thank you for the $10 of support. He's saying keep fighting. I don't know how else. I mean, I'm tired. I'm exhausted from all these fights, Joshua. I mean, I was complaining about Mitch because Mitch is like, Travis, when you calm down and when you focus, you're lethal what you do. And I'm like, brother, it's like, it's so hard to take a hat off and put another one on. I'm in Kerr, Texas doing search and rescue, and then I'm getting assaulted, have to do a civil rights thing. And then I got to manage the channel. It's just so much. And not to mention I'm a father and a husband and I love my family. Joshua, thank you, brother. It means a lot to me that you're doing that. Now, let's see here. Where is the Mitch will never be allowed? Look at that. They're saying that you'll never be allowed to run for office because they cannot control you. Okay. Pirate Justin, I will vote for Mitch. That's 2 votes right there, Mitch. We got Mitch 2. We got Mitch 2 votes. It's something. Anyways, and this is from P Nice. This is a good guy. Mitch is playing his part. It's up to us to educate the people around us. I mean, that's what Mitch and I'm sorry, Monica. I thought you were gonna come. I almost called you Monica. I was so busy. No, not Travis for you guys. I'm not smart. You know, I'm barely make it. I will just get upset and emotional, and I'll just fire everyone. So maybe you guys do want me in. I mean, I will fire everyone, especially just give me 1 ounce of fraud that you've committed and you're done. That's it. There's no immunity. If you break the law, you're out. It's okay. It's okay. I'm glad you're here. Monica, I appreciate you, by the way. All right, let's get into the video. I'm going to put us on mute. Here's our first PPI video. This came out yesterday. And we're going to lead into inflation. And I'm going to show you guys the reverse repo market, which is pretty crazy. But inflation is really bad. Let's start with PPI.
July release of the producer price index. Headline number is whoppingly big. Oh my goodness. Up 0.9%. Up 0.9. And if you strip out food and energy, guess what? It's still up 0.9. Boy, that equals June of 22. You're to March of 22 on the headline to find a bigger number. On the core number, that would comp to March of 22, since we've had a number of that magnitude when it was 1.2%. These are kind of COVID distorted numbers. Now, let's look at ex-food, energy, and trade. Triple the expectations. All 3 of those were expected to be up 0.2. This is up 0.6. 0.6 would be the highest level since March of 22 when it was 0.9. Now, let's go year over year. These are warm too. 3.7, excuse me, I'm getting ahead of myself. Final demand year over year is 3.3. We're expecting 2.5. Now, 3.3, that would be the highest since February. The high water mark was January this year at 3.8. Now, 2.8 is ex food, energy, and trade. That is definitely higher than 2.5 expected. 2.8 would be the highest since March. And right in the middle there, we have ex just food and energy. That number coming in at 3.7. I kept it for last because that really is a very, very large number. 3.7, well, that would be the largest since March when it was 3.9. So we see every single metric is warmer than expected. Every single metric is significantly higher sequentially. Now let's go to initial jobless claims. Here's a bit of good news, 224,000. That's down 3,000 from a slightly revised 227. And we're the 12th consecutive week above 1.9 million, and continuing claims, 1,953,000. Once again, it all gets stacked up pretty tight. What we're thinking about is these numbers go all the way back to November of 2021. And the next jump up from these numbers will be when we pop over 2 million. The last time we did that was, as I said, Nova 21, 2,041,000. So we saw interest rates move up to this kind of 4.25 level in 10s. The 2-year has moved up to a bit to 370, and every maturity now, except for 30-year bonds, are higher in yield. 30-year bonds are virtually unchanged. Next week on Wednesday, we get a 20-year, but you know, on the supply side, it's a bit in the rearview mirror. We didn't have terrific auctions, and I'm going to throw it back to you guys. I'm a little surprised the markets haven't moved more on it, but the knee jerk is usually against expectations. The residual trade down the road here today will be about how this factors into the bigger picture.
Okay, that was interesting. We're going to go straight into the inflation right now, this is a really important segment because what we're learning is the inflation is really destroying us and our quality of life. It's making it to where pretty much none of us can afford to live. So this is really important to pay attention to, guys. I have a really nice lineup for you guys, just so you understand. If you're wondering, like, why are prices not going down when there's so many people that are suffering? We had way less happen during the global financial crisis, and we had a complete collapse in prices. Why hasn't that happened right now? What, and I had to look at that myself. I'm like, okay, well, why is a lot of areas that I'm around in Texas and even in Florida, why are they going down? But East Coast is not. The market's all-time highs. It's the inflation. And here's the thing that I believe, and this worries me. I talked to Mitch about this. They got more room to go. And here's the Dixie. So there's nothing. I mean, the problem is the entire world, for the most part, is intertwined with our debt. So the Dixie is only at, I mean, it's low. $97.79 is low. But let me show you guys what it was like during the global financial crisis. And this is what I'm saying. They can mess us up a lot more. Look at this is during the global financial crisis to get down to 80 and also in the 70s. So the Dixie has more, they have more room for inflation. We don't, mom and pop don't, because the asset prices, but you guys, we got to stop them because they can literally, even with all-time record highs, even with median income, they can continue to do this until we all get, until it collapses in on itself. And when I say collapses in on itself, I mean when it collapses in on us as American consumers. This is horrible. $97, and it's still so much more room to go. Oh my gosh, thank you so much. Brinsway, I really appreciate that. That's a really cool dog right there as well. I really appreciate that support. I'm going to keep going. I need you guys to also understand this. A lot of people are only talking about the 37 trillion, right? You guys understand there's 37 trillion. I'm circling it upper left of your screen. We get that. But what people like refuse to talk about is this huge number here, okay? This 105 trillion. You see that? I'm circling that right above my head right there. There's $105 trillion in unfunded liabilities, meaning we still need that money. We've already, and that's like Medicare, Social Security, things like that. But look at guys, we only have 113 million taxpayers. So we have 113 million taxpayers, okay? Anyways, when I do the math on this, each taxpayer is in about $2.2 to $2.4 million in federal debt. And that's not even talking about the central appraisal districts. That's not even talking about the ISD bond debt. When we add the ISD bond debt, it gets closer to 3 million. But right now we're at $2.4 million of federal debt each taxpayer. If you have two taxpayers in your household, that means, just like I do, that means you're in $4.8 million in federal debt. That's not fair. We didn't ask for that. The things that they're spending their money on, it's not good. Here's another reason why we have all-time high asset prices. Without deficit spending, we would not have all-time high asset prices. This is updated. So even though they're pulling money from tariffs and things like that, we're still 7% higher year over year in our deficit spending. So we're on a pace of probably close to 2 trillion in deficit, but we're at 1.628 right now. And just to prove to you guys what I'm saying, okay, look at the deficit spending again right here. Okay, this is a global financial crisis. They had to deficit spend us out of recession. Okay, so they did this because they had to prop up the economy. And they said they're going to do that because it helps me and it helps you. But the reality is this didn't help me and it didn't help you. It only helped the banks. So if this is what they did to keep us out of the biggest recession of my lifetime, the global financial crisis, then what do you guys think this is here? I mean, this is case in point. Without this here, where my arrow's at, without all of this deficit spending, we don't have all-time highs in the stock market. We don't have crazy inflation. This is why that we have a GDP in the positive. But is it really in the positive when we are drowning in debt? To me, if you're saying that, it's just not something smart to say. How could you say we're making money, but we're drowning in debt? That's bankruptcy. You can't cover your debt, and your debt's accelerating. But here's another reason, okay? The inflation. And look at it as far as the trajectory of inflation. Ever since the global financial crisis, about right here where my arrow's at, look at this trajectory. This is why we have all-time high prices. It's not about fundamentals anymore. It's not about the math anymore, at least for this time period. And that's the problem because it hurts us all. But let's keep going for the inflation. Here's another thing. Look at this. This is a Buffett indicator. This is how overvalued stocks are. All-time record high, 209%. This is a Wilshire 5000 to GDP ratio. We're at 209%. We have never in the history of America had things as overpriced and bubbly as we have right now. There's nowhere to go. Look at, here's the stock market. Again, 209%. That's the Buffett indicator. Let's keep going. Asset prices for houses. And here's the problem with houses. It's our shelter. You shouldn't tax us out of our shelter, and you shouldn't lever up our houses. And that's the problem. If I have a $300,000 house, it's not really a $300,000 house because of the way the capital markets work. They take my house that's collateralized in a loan, mortgage-backed security, and they can lever that up 20 to 1. So my house is now worth $6 million in leveraged up debt that some other people are making money off of. Stop making money off of my house. Stop making money off of our houses. It's our shelter. Leave us alone, for the love of God. I don't want to make any money on it. Just let me live there in peace. Let me know if you guys agree with that. But either way, when we look at the PE ratio, it's just so bubbly in the housing market. We're at 7.3. There's different data points, but you guys get the point. Asset prices are through the roof. Look at this, guys. Not only are asset prices through the roof, what happened to the quantitative tightening? You guys remember that? We're supposed to have quantitative tightening to help out the consumer, but really what happened is they just whiplashed us and rug pulled us because the M2 is going up again. This is the one-year outlook on the M2. This is not good. So when people say, well, the all-time highs, just keep buying. Okay, yeah. It's working for you so far because of what I just showed you, but there's no fundamentals in it. So, and I get it's gambling, but it's just not something that I'm going to take part in. Okay. M2 is going up. Huge problem. Look at this, guys. This is the Treasury General account. The trajectory is going up. That's interesting because it's after collecting taxes right here. So they spent a lot of money and then they got a lot of money. So I'm wondering what this is from, but that's interesting. Treasury is going up. Now look at this. So I showed you guys all-time record high, right? Maxed out. And then we get to the quantitative easing account. So QE account, which is another name for reverse repo market. Look at this. So recently, the reverse repo market has been plunging. So again, I showed you guys all this stuff here, all-time high, all-time high, all-time high. So this could spell potential turmoil in the banking sector, which corresponds with what? A September rate cut. For who? For us? No, not for us. For them, because the overnight reverse repo market is for banks. It's a form of quantitative easing or an unfair advantage that bankers are getting over us. And it's almost out, 28 million. It's never been this low since it's been operational anyway. So this is an all-time low. I was talking to Mitch the other day about this, and I asked him, what his thoughts are on the reverse repo market at plunging right now, and if that's a sign of potential turmoil in the financial market. So, Mitch, before I go into our mortgage report, you want to kind of tell us what you think is going on with the reverse repo market and whether or not it's going to lead to more money printing, which is really what I'm asking. I don't give a crap about that account. I just want to know, is it another sign that the banks are losing the backstop from the Federal Reserve? And is it a mechanism that they're going to use as propaganda to say, oh, there's turmoil now, we need to put more money in there? What do you think's going on with the reverse repo market?
There's turmoil already existing, and you started this segment proving it, which is the 1.628 trillion deficit on the U.S. national debt right now, today. One must realize that in 2024, it was 1.8 trillion for 12 months. We're not even through the year, and we're already at 1.628 today. Take 2024 plus what appears to be coming at 2025 by the end of this year, give or take, you're pretty close to 3.8 trillion in 2 years. That is a deficit. In order to have that deficit, that means they're going to print money to cover that off. Never mind the reverse repo. Then it gets worse with the reverse repo, because what they do with that is the Federal Reserve accepts at face value mortgage-backed securities that are held by the banks. They accept at face value credit default swaps, credit default loan obligations. They accept all these things at face value, which clearly aren't true, in exchange for U.S. Treasuries handed off to the banks at nighttime, so the banks can manipulate their balance sheets and say, yeah, but look at all the U.S. Treasuries we have, and then we'll go and borrow based on the U.S. Treasuries, never mind what the real value is of the mortgage-backed securities, that at a minimum is 40 cents less on the dollar, such as Freddie Mac, Fannie Mae, et cetera. So left hand, right hand, it's all kabuki theater. And the point that I want to make, that compound interest calculator that's on my website is not only applicable to mom and pop and every property owner, it is also applicable to the US national debt. The math is the math. That chart that's on that compound interest calculator is exactly what the Federal Reserve is doing. So we're getting hit in two directions. A, from the school districts on the outstanding bond fraud, B, from the Federal Reserve, and nobody, and I mean nobody, can beat that chart up. That's a fact. That's the math. And it shows going upper to the right. That's the graph of the debt added upon the debt. So it's principal plus interest, clicking away by the nanosecond. And that's what you see in the usdebtclock.org, except you don't see it graphically. When you understand it graphically, then as I said, there's only one question. How exactly are you going to pay this off? Well, the answer is you've got to eliminate the fraud. There is no other answer. You got to eliminate the fraud. And then on the local side, you have to repeal all property tax in favor of the uniform state sales tax. That's how you fix this. And President Trump is on the right track. I don't know what he knows below the line. From the top of the line perspective, he's going after big money to increase the revenue. It's not enough. It's not going to be enough. He's got to look at the bottom line and say, how are we going to fix these expenses? The way you fix the expenses is get rid of the fraud.
Okay. And that goes into the whole property tax and consumption tax thing. So part of eliminating property taxes is also eliminating the existing ISD bond debt. Because remember, you guys, that bond debt is like a mortgage. It is amortized over 20 or 30 years. And because you amortize the debt, and I'm going to show you, this is a perfect segue into mortgages, which is what we're going to cover right now. It ends up costing double what it actually is, just depending on the interest rate. And I'll show you that here in a minute. So remember, if you're going to talk about repealing property taxes, substituting with a consumption tax, we've already done the math. There's a bill. It's in Texas Ledge. We've literally already done it. And I think it starts at 13%, Mitch, or 15%, goes down eventually to 11%.
It starts at 15 for 3 years until this is stabilized out. And the only reason we did that, we pre-negotiated the ability, because nobody knows how bad the outstanding school district bond debt is. Our numbers are conservative. That 5.1 trillion is conservative. The 660 billion in Texas that they're responsible for, that's conservative. So the point is, we hit it high to cover off anything contingencies that we can't see today. But when it stabilizes out, it will be between 11 and 12%, which is completely tolerable, because right now today it's 8.225%. The delta in reality is the fraud. When you get the fraudsters out of the middle, all of a sudden this stuff settles down and it works.
All right. And again, you guys, remember, just with the fraud, remember amortization. Remember compound cumulative. Okay. Amortization, compound cumulative. They're not paying off the debt. And the existing debt to service it, not even barely pay it off, is trillions of dollars. Literally, it's $1 trillion for our federal debt. Just the debt that they have costs us even more debt of $1 trillion. So it's debt on top of debt on top of debt. Is parabolic.
On top of interest on top of interest.
On top of greed, corruption, and fraud.
Well, give or take.
On top of the backs, on top of the backs of mom and pop too. We'll keep going. Let's go, man.
Yeah. So
it's a bad deal.
Yeah. Every 7 years, this compound cumulative debt will double up roughly every 7 years, just depending on the interest rates that are applicable for what's going on under the hood. So you go up 30 years, you're up 3x. However, your payments on that debt on a monthly basis are up 11x. That's how the amortization schedule works. And that's why I keep saying, if I had the opportunity to sit in front of Governor Abbott, I literally would put that chart in front of him and say, how are you going to pay this off? And he's going to stumble around because he's an attorney. Most attorneys aren't very good at math. He's just simply going to stumble around. But the point of the matter is, stop stumbling. I'm giving you the answer. I'm handing this to you on a silver platter. This is the reality. Are you going to take action or not? If not, you don't deserve to be sitting in this chair. Get out.
All right, we're going to watch Get Out, right? Like, did you guys hear that, politicians? Just get out of office. If you can't help your people, if you're just going to take the money, if you're going to give up, just get out of office. You're not meant for office. And that's just the reality that we're learning. So we're going to go into our mortgage update, starting with this video. Then we're going to go into a few other things I want to go over with you. I'm going to put us on mute and we're going to watch this real quick, Mitch.
On the move, Diana Olick has the details there. Diana.
Well, John, rates continue to fall. The average on the 30-year fix dropped a little more today to 6.53%. That's the lowest since October. It had been holding in a very narrow range over the past several months, but appears to be pushing lower for now anyway. That is driving refinance demand. Those applications jumped 23% last week compared with the previous week, according to the Mortgage Bankers Association. That's the strongest week since April. Refis are now climbing to close to half of all applications. And that's because demand from home buyers is not reacting as well to lower rates. Those applications up just 1% for the week. But what's really interesting in this week's report is the surge in adjustable rate demand. Those applications jumped 25% to their highest level since 2022, and the ARM share jumped to nearly 10% of all applications. Now, the average rate on a 5-in-1 ARM dropped to 5.8% from 6.06. These are considered riskier loans, but what's really interesting and potentially concerning here is that ARM demand usually rises when interest rates rise, not when they fall like they're doing now. And that's because as rates rise, people struggle more and look for any way to lower their rate. So it's a little.
Okay, so she said a key word right there. When people struggle more, they look for a lower rate. And I'm going to tell you, as someone that has been in mortgage for over 20 years, 100% right. Some people are so desperate, Mitch, that all they want is a skip mortgage payment, because when you refinance, you get to skip a mortgage payment and their payment to go down $100. They don't realize that by refinancing, they start the entire amortization schedule again, and all of the money that they put towards interest, like it could be $20,000, $30,000, $40,000 in just fees, it starts all the way over again. So I want to paint a picture here in a minute of why refinancing is so bad. But to the point of the video first, let me go and let's go over the, okay, this is crazy. Okay, we're going to go over.
There's one issue.
All right, we'll do that at the end here. But I want to go over this real quick because we're losing time. We're at 46 minute, Mitch. This is what I wanted to show you guys. Okay, this is the demand for mortgage applications, whether it's a refinance or whether it's a purchase. Now, the blue lines indicate the actual application. The orange line that you guys see here is the interest rate. So you guys see that the interest rate went from 6.72 down to 6.58. So what is it? It's not even 20 basis points, right? So it's barely anything. And look at the trajectory of refinances. Look at this trajectory. It's skyrocketing upward for the slightest, not purchases, guys, refinances. And to me, what I'm trying to paint here is no one that is financially responsible, no one that understands amortization, understands long-term investing is going to jump on the bandwagon and do a refinance for a quarter point less, because they'll understand that the amortization schedule is going to keep you trapped. These people that are jumping, just running into a refinance, it's not good. For 6.58%, are you kidding me? Or they're taking, like she said, an adjustable rate mortgage. That's what happened during the global financial crisis. Why are people still taking adjustable rate mortgages? And here's my case in point. Purchase demand barely went up. Look at this. So you got a slight tick up. Hopefully you guys can see that. So as rates go down, barely anyone comes back in the purchasing market. And these are just applications. They haven't even closed on this yet. So it's not ticking up because the price is too high. And if the prices are lowered, like where I live, prices are going down where I live. The problem is property taxes went up so much. So it's a bad deal. Mitch, I just wanted to show them a couple more things, and I want to get back to you, but I want to finish the segment. Here's interest rates right now. 6.15% for FHA. Conventional is at 6.56%. A lot of people are wow, there's a lot of gap on that 15-year. So there was a time period where FHA was under 15-year. That's pretty crazy. So 15 years actually under 6%. But a lot of people are like, well, what's the advantage of FHA versus conventional? Okay, so FHA has a lower interest rate. FHA requires a lower down payment. FHA has more flexible financing, right? So it's more flexible. You can have a little bit more lower credit and things like that. But the one disadvantage is mortgage insurance lasts forever, and there's a lot of preconceived notions that only people with bad credit get FHA. So who cares about the preconceived notions? It's mortgage insurance. Okay. For the sake of argument, FHA will always have mortgage insurance. It's called MIP, mortgage insurance premium. Conventional, the PMI, private mortgage insurance, is going to fall off eventually. As long as it will fall off automatically when you've reached 22% of equity, or when you're purchasing, if you have a 20% down payment, or if you write in and request at 20% as well. But if it's an automatic thing, it's 22%. Okay. Now, here's what I wanted to explain. And this is Mitch's huge point here. So just like government debt, just like ISD bond debt, it's just thrown in the amortization schedule. And as you guys know, amortization schedules are front loaded with interest. For example, on a $400,000 loan, 30-year fixed, today's interest rate is 6.56%. The first year of payments, okay? And by the way, the monthly payments are $2,500. So you pay $2,500 for the whole year, okay? For that entire year, you're paying $2,500 payments. $26,000 is paid towards just interest, which is another word for fees. And only $4,400, less than 2 payments, go to a principal. I want to say it again. Less than, for an entire year, less than 2 payments go towards principal. That's why, and the government's not, you know what, Mitch, if the government really wanted to wind down the debt, just make some extra payments, right? Just pay biweekly or pay extra money towards your principal, and don't just leave it there. Because as you guys are going to see here, if we pay extra monthly payments, say $500 extra per month, all right, let's calculate this. If we pay $500 extra per month, it turns into a 19-year loan, okay, instead of 30 years, and you save in interest. Look at this, okay? This, oh no, here we go, right here. Interest saved, right here, $200,000. You literally save half of the loan amount. Again, the loan amount's $400,000. You pay the extra $500 a month. You save $200,000 in interest, and you pay this off roughly 11 years early. That sounds like a great thing to me. I mean, that's how amortization schedule works. That's what Mitch and I have been pounding on the table about. Like, you guys, pay your mortgage off, pay it early. It's a horrible thing. It's literally a death contract. And I want you guys to understand now, put this all together. The government and the independent school districts aren't doing that. Instead of them making extra payments towards principal, they're getting into extra debt to pay interest. So they're not making money and being frugal with the budget, paying extra money towards principal. They're just creating more debt to make the payments. Mitch, to you, sir.
I'm going to come right back to that amortization schedule that Travis just showed you, but that reporter is right, except for the wrong reason. So the ARM, which is the adjustable rate mortgage, today is being used as a reflection of the cost of housing expenses. So the cost of housing is up. So to make it more affordable, the homeowners are trading short-term interest rates and gambling on the stability of not having a fixed 30-year mortgage that can be paid down, which is what Travis just showed you, as seen in that amortization schedule. ARMs today, you are trading for your future of stability. And if you do a 30-year fixed rate, you have the advantage because you can pay it down. There is no advantage in an ARM. You're being manipulated into something that you probably shouldn't have because you can't afford it, but you're looking at it and saying, well, the cost of housing is up, so I'm going to trade it off. That's the problem.
It's a big problem, right? Like, I hope you guys understand that, right? So amortization schedule, super duper bad. And that's why there's so much debt and so much taxes. Okay, so now we're going to go in and we're going to talk a little bit about real estate, and we're going to talk about commercial real estate. Now, I was one of the guys that thought that commercial real estate would be a black swan, right? The tipping point, or at least a big tipping point. And I'm going to have us listen to 2 different videos. It's not that long, you guys, but it's going to go over commercial real estate and how commercial real estate is making a drastic comeback. Okay, so that's 2 videos, very short. And then because Mitch is an expert in commercial real estate, then we're going to get his comments. But take a listen to this, guys. This is absolutely interesting. Okay, that's why I'll lead with it.
Welcome back. 5 of the biggest commercial real estate companies, CBRE, Cushman & Wakefield, Newmark, JLL, all raising their outlooks for 2025. It's the first time, actually, all 5 have increased guidance since 2020. Joining us now is Colliers President and CEO of the U.S. and Latin America, Gil Barak. It's good to have you, Gil. So is the outlook improving for you too?
Thank you. Thanks. Good to be here. Yes, the outlook is improving for us as well. It seems to be we're in that part of the commercial real estate cycle that seems to be the beginning of an upside, something we haven't seen in probably about 3 years.
Why? What's driving that better outlook at this point?
It's hard to pinpoint, but I think that for the most part, those that are active in commercial real estate, investors are getting on with it, if you will. It's taken a long time to get used to the fact that interest rates are higher than they were, for a number of years leading up to 2022. And we did see a significant decrease in activity as investors got used to the idea of underwriting at a more expensive price. So I think one of the major reasons is there's capital to deploy. There's pressure on funds that were created in the early 20s to deploy capital. And folks seem to be finally at the point where they're getting on with it.
Not yet, Mitch. I know you got something to say. I got to tee this other one up, okay? I know you're salivating. Get on with it. Did you hear that guy? How much money is that guy in charge of to say that people are just going to get on with it? What about the math, brother? What about the fact that the math just doesn't work? What about that? Why aren't you talking about that? What do you mean get on with it? Okay, now here's another video that's going to try to explain, this is interesting, quantum computing and how quantum and like AI factories are actually going to give potentially a boost to commercial. Listen to this, guys. It's pretty interesting.
AI demand has ramped up exponentially. Trillions of dollars have been committed to building data centers. But now a different technology is emerging, and it could drive the next leg of real estate growth. Diana Olick joins us now. She has the details in today's Property Play. Diana.
Well, David, until now, quantum computers have mostly lived at academic or government facilities because they had limited practical applications. But quantum computing is fast becoming commercially viable. And as a result, it needs its own real estate. A new report from JLL says significant real estate implications are, quote, on the horizon and on the scale of what we saw with AI and data centers. But quantum computers can't live in data centers now, at least not in the current ones. The racks and the physical form of a quantum computer are different, and they require electromagnetic shielding to prevent so-called noise. And that noise is any outside disturbance, be they electrical, magnetic, vibration, or sound. Now, since these computers are already at academic or government institutions, it makes sense that new commercial development will be concentrated in those regions where they have access to the academics and the trained workforce. The top 20 global quantum markets today have formed near national research centers and universities. In the U.S., that includes Chicago, Boston, New Haven, Connecticut, parts of Colorado and Maryland, and Southern California. Silicon Valley's PsiQuantum chose a Chicago steel mill complex to open a facility funded primarily by the state of Illinois. Now, the Illinois Quantum and Microelectronics Park, developed by Related Midwest, is set to span 128 acres or roughly 5.6 million square feet. And this is really just the beginning, the edge of what we're going to see in what is now being called quantum real estate. Now, we have much more of this in today's Property Play newsletter. If you haven't signed up, please do cnbc.com/Property Play or use that QR code. Back to you guys.
Yeah, I've talked to Jeff Blau about that giant complex you just mentioned in Illinois, the Related's behind. What about, don't these things need to be incredibly cold? I thought like they need levels of temperature that are really low.
Yeah, they need a lot more than your AI computers do. And that's why we're probably going to see more energy needs for this as well, which, as you know, we're already talking constantly about how much do we get more energy to data centers for AI, whether it be geothermal or solar or nuclear energy to power current data centers. This is just another level of energy that we're going to need for quantum.
Yeah. Diana, thank you. Diana Olick. And we should note as well,
All righty, guys. So I'm going to lean on you a little bit. Let me just real quick, though. Quantum computing blows my mind. I'm so fascinated by quantum computing and quantum physics. I always go down those rabbit holes. And then quantum entanglement. We don't have to talk about quantum entanglement, but my gosh, it's so fascinating to me. Mitch, you are an expert in commercial real estate. I mean, you just literally just got a portfolio from the Bank of Lindsay. That was one of the banks that went under, I think, last year in 2024 because of fraud. So you get a bunch of distressed commercial real estate opportunities across your desk. I think 30, 40 a day. Would you agree that at least the possibility that she has a point that quantum computing and AI is going to lift commercial real estate out of the abyss in which it lives?
No, not a chance. Complete nonsense.
Why?
Well, okay, look at it this way. Moore's law, which says that the computer power based on the transistors, the chips, et cetera, doubles every 18 months. So if you start from today and you go at 18 months and the power of the computer, its efficiency doubles every 18 months, for what purpose is a utilitarian building that's being built today going to be in 3 years from now? The odds are that building isn't going to be necessary. Now, to her point about the power demands, okay, power is going to be power regardless of what form the computers take. However, those people who are participating in the creation of a utilitarian building, meaning the building is designed for a specific purpose, including the EMFs, the electromagnetic fields. Okay, that's fine. But it is a utilitarian building. It's just like a movie theater. Movie theaters today aren't worth anything. There's not that many people participate in going to movies anymore. So therefore, you have a utilitarian building. What's its next use? Demolition. So when they say, well, it's going to fix the real estate, it isn't going to fix 0.025% of the outstanding real estate. And over and above all that, given the inflation and the economic risk that we've seen going up by the nanosecond on the usdebtclock.org, how can any tenant, be it commercial or residential, afford the rent? So I'm a monkey in the middle. I'm a builder developer, and I'm only as good as my tenants or residents can pay the rent. Right now, today, multifamily is under construction such that roughly 70% of the future occupancy is credit risk, meaning that roughly 70% of those about to be residential tenants in that multifamily building cannot afford the rent, meaning they're going to have roommates, they're going to have help from mom and pop, whatever it happens to be. Why would I go to construction looking down the barrel of 70% credit risk? Why would I get involved in a utilitarian building for which I don't know what the future is in terms of the ability to use that building? See the problem? They're not asking the right questions. The right questions are, what can you do with it if something goes wrong? They didn't answer that. This is just a hype piece.
Speaking of a hype piece, Mitch, are you a quantum computer? All right, I'll take that laugh as a no, you're not. All right, let's move on to the Federal Reserve, potentially a couple nominees or candidates, if you will, that it's kind of going around. There's rumors spiraling. Like, I think there's about 12 people or 16 people that are potentially going to replace Jerome Powell. And you see, the thing is, it's maybe propaganda because every one of the people I've listened to so far, Mitch, wants to do aggressive rate cuts. So, but they're not exactly. Actually, the second guy explains it a little bit better. But before I do that, let me show you the lack of aggressive rate cuts. And I'm not saying that's a bad thing at all. I just wanted to show you what's going on with the market about a year out. So first of all, the market thinks that the Federal Reserve is going to cut interest rates in September by a quarter. Okay, because right now we're at 425 to 450, which is 4.25 to 4.5. So 100 basis points equals 1%. Okay, but look at this, guys. I'm going to go to the end of the year to December. And what's interesting, if we look right here, so this column right here, the market is saying that there's roughly about a 45% chance that the entire year we're only going to get a total, counting September, of 50 basis points. Okay, and that 50 basis points is going to do nothing for you and I except somehow hurt us. It's going to create inflation. The bankers are going to keep banking and keep making money. The bankers are going to keep that yield. They will not pass on the 50 basis point cut to us as consumers. They're going to keep the 50 basis points for their yield and profit margin. So I hope you guys understand that money's not going to go to us. They're going to keep it. They always do. But look at when I go to July of 2006. This is interesting. So when we go a year out, so actually 11 months from right now, okay, if we go 11 months from right now, okay, and we look at the highest probability that the market is saying, 29% chance that 1 year from now, the total amount of rate cuts from right now to 1 year, 100 basis points, 1%. And I'm going to tell you guys that 1% is not going to translate to you and I. It's not. They're going to keep that. The only way that the Federal Reserve can continue to manipulate interest rates is just like in 2009 and 2012 through Operation Twist is mortgage-backed securities. It is not, the market is too oversaturated. The rates were too low for too long for just the federal funds rate to go down. So you guys are going to see this. It's going to take the federal funds rate going down plus horrible either mortgage-backed securities or quantitative easing in the form of the Fed purchasing the 10-year or the longer end of the yield. That's the only way they can get it down. Because again, you guys, when they cut, it's because, and we looked at the reverse repo market, it's supposed to stimulate the economy. And when I say economy, I'm just saying the banks. So it's going to stimulate the banks. They're going to keep the yield. They're going to keep that difference. And you and I are going to still be paying high prices until everything collapses in on itself. At least that's what I'm thinking. So let's listen to our first video. And this is from economist Mark Summerlin. Now, he does a little bit better job. We're not going to listen to the whole thing at all. We're only going to listen to, let's see here, 3 minutes. So we're going to listen to 3 minutes of Summerlin, and then we'll listen to about 4 minutes of Zervos, and then we're going to get y'all's opinion. But here's the first guy that's apparently in running to replace Jerome Powell. Listen to what he has to say. 3 minutes.
We already been talking about this gentleman all morning long. The Fed, the central bank's leadership, and more. Join us now, Mark Summerlin, who served as deputy director of the National Economic Council in the George W. Bush administration, now managing partner of economic consulting firm Evenflow Macro, and is that a Pearl Jam song? And has been mentioned as a possible candidate for Fed chair. I think it is. Great to have you. Mark, thanks for joining us this morning.
No, thank you for having me, Joe. It's a privilege to be here.
And I'll tell you why, if your ears were burning, why we were already talking about you. I was trying to summarize some of your feelings about where the Fed is right now. And I was citing your notion that some of these numbers we have learned are so maybe revisable or not like just, you can't, they're not just concrete numbers. And 1 to 3% on inflation is about the best that that agency can give you. And that the Fed is, if it's 1 to 3, they're within the range. And if employment looks weak, you should cut.
I completely agree with that. I mean, we can't measure inflation with any type of precision. We actually impute a lot of the numbers. And the Fed can't control inflation with any sort of precision down to the decimal point. And so if you look around the world, what we see that almost every other central bank does, in fact, there are 48 of them that have an inflation range. And it's just common sense. It's like we want inflation to be 2%, but because we can't exactly know exactly where it is or how to control it, we pick a range, something like 1 to 3%. We're well in that range right now. If you look at CPI that came out this week, in January, the 6-month annualized CPI rate was 3.6%. That's down to 1.9%. There are other measures that show we're in the 2.5 to 3, but pretty much everything's in that kind of 2 to 3% range right now. So that's not the worry. The worry is that these job numbers got revised down very big, unusually big. And before that, we had a disconnect where GDP numbers have been weak, about 1.1% for the first half of the year. Jobs number has been strong. And then the jobs data got revised towards GDP. And so we now know that the economy has been growing weaker. And so a 4.33 Fed funds rate is just too high. And the market will always tell you what you should be doing. And we see the inversion at the front end of the curve, which is over 50 basis points, tells us that we could easily do a 50 basis point makeup cut because the data had been wrong in the past without disrupting anything at all. So it seems like pretty much a no-brainer to me.
Not yet, Mitch. We got to listen to one more. A makeup cut? Are you kidding me? For what? It's not going to change anything? Then why do the makeup cut? If it's not going to change anything, then why do the makeup cut? To me,
no, you're missing the point.
This next guy?
Huh? Kiss and makeup. Right?
Kiss and I mean, stop taxing us. How about that? How about they do that? Absolutely crazy. Okay, we gotta listen to this next one though. This is Zervos, and then we'll see who's the better of the two. This one hurt. This one hurt me to listen to. This is now Zervos again. We're listening to the man that's next candidate to replace Jerome Powell, the Federal Reserve Chairman. Why aren't they talking about closing down the Fed, ending the Fed? That's why I'm so worried about the administration. I'll shut up.
Officially now bring in David Zervos, chief market strategist at Jefferies, as well as a CNBC contributor, also on the not so short list of 11 candidates who may replace Jay Powell. Welcome, David.
That was a long introduction, Melissa.
It was. I mean, there's so many mantles which you carry these days. But
and a frequent guest here, which is how we know him. We don't really care about the other stuff.
What did you make of the number today?
I don't make a lot of it.
Okay.
Steve said it's a very volatile number. There's some really quirky stuff on the services side. I think 80% of this gain was in services. There was the good side was relatively tame. Also, if you look back at core PPI, the year-over-year figure, we were cutting rates when this number was even higher in Q4 of last year. So the September, October, November, December prints for that core PPI were higher than this 3.7 number that came out. So to be honest with you, and Jay was perfectly comfortable cutting rates then. He's not very comfortable with it now. I think a lot of this stuff is noisy. It doesn't make its way through to core PCE, doesn't make its way to core CPI, and we'll see that in the numbers ahead. And there's been a lot of very good news on inflation, at least to start the year, and certainly over the last couple years as we've come from those incredibly high levels.
So the narrative today that this number may give the Fed a reason to pause or to rethink cutting rates, any of that, along with CPI and the fact that services side of CPI was greater than what had been anticipated and goods remained fairly tame. None of this changes your view about what the Fed should do.
Well, you cast that in a very unusual way for me. I have been over many years here at this table and on other tables on the network, been very careful not to talk about what the Fed should do, because I've never really felt like what I thought the Fed should do mattered. I just tell you what I think the Fed will do. Now that's a little different, Melissa. So I think I'm sitting in a position with a very esteemed group of people, and I'm very honored to be there, where maybe what I think the Fed should do does matter. And we've had on this show, I think for the last 6 or 8 Fed meetings, Kelly has asked about, what you think, what you would do if you were there. We had a shadow committee. I think in the last 3 meetings I have said I would say 50 basis points. I was one of the few. I think there might be one other in that shadow committee that they're putting up there. And I'm still there. I'm still absolutely there. I think there is a reasonable storyline, a very cogent storyline that suggests monetary policy is restrictive. It's gotten more restrictive. The arguments I put forward have been related more to the balance sheet and that contraction. But generally speaking, I don't see any reason why this number changes that view.
So a 50 cut in September. After that, though, would you be data dependent and open to the idea that tariffs may then translate into inflation later on and a few months down, which a lot of economists out there, like Jan Hatzius of Goldman Sachs, for one, which President Trump took issue with, but made the point that it could be the consumer that will be then handling the burden of tariffs down the road.
Watch the evidence. I think I would be watching all the evidence, all the data carefully, recognizing that high frequency data is extremely volatile and does not portend longer term trends. But I think there's a very cogent case to be made that we are way above neutral in rates, and that getting rates back toward neutral would bring in many, many jobs. We have a 4.2% unemployment rate right now. We had in 2019 a 3.5% unemployment rate with very little inflation. There's no reason why we couldn't be going back there, or I think with some of the supply side reforms going even lower than 3.5. So we've got a million jobs, maybe more, on the table that could be brought in if we don't get too obsessed with this last little bit of the inflation battle. And
Okay, real quick though. Ryan, I'm gonna ask. We're gonna give you an update. I saw that you wrote that a couple times. I just want to put your comment up to let you know that towards the end of this, we'll give you an update with the DOJ and every enforcement agency that we've reached out to. Couple people made a comment like Zervos is like a car sales. I mean, and the impression I got by listening to Zervos is, how the hell is this guy here right now? You know, how's this stock market bull going to be in charge of my balance sheet? Are you freaking kidding me? And Trump is put, so they're both talking about aggressive rates. At least with Summerlin, he also talked about aggressive rates, so that's not good. But at least it wasn't as like, hoorah, let's freaking go, right? Who cares about the math? Let's just go. Let's just drive it up. I'll listen to we'll listen to the last video here before I get your response, Mitch. We have one more video. Now, this next video, and this is about the Fed chairman. This next guy is basically David Weasel. What's with these people's last name, by the way? Now, he seems to think that, you know, these people are coming online talking into the news because of propaganda to put more pressure on Jerome Powell. So he's saying that it's all a game, it's all a gimmick. After this last clip, you guys will resort to Mitch, and we'll see what his opinion is on these bums.
Stick with me here. Let's bring in David Wessel, Senior Fellow in Economic Studies at the Brookings Institution. He suspects that putting more names on the Fed chair potential list will put even more pressure on Powell when it comes to rate cuts. David, let's put this back on the screen here, these Fed chair candidates for just a moment. It looks like a choir all singing against what the Fed chair, Jay Powell, has been doing, and perhaps in support of President Trump's call for rate cuts. What do you expect the impact of this large field to be?
Well, first of all, I'm a little suspicious of this list. Lori Logan, for instance, the Dallas Fed president, has been pretty hawkish. It's hard to believe the president is going to put her on the board. The current vice chair, Phil Jefferson, has been pretty low profile. He's a Biden appointee. He's been aligned with Jay Powell. So I wonder what this is all about. One possibility here is that Secretary Bessent is putting names up there, and then that encourages people who think they have a shot, either at the chair's job or maybe a seat on the board, to write or speak out in support of the president's call for lower interest rates. Mark Summerlin wrote an op-ed the other day endorsing the president's call for lower rates. So I'm not quite sure what to make of this, but I agree with Steve. It does suggest that a decision isn't imminent. I just don't really believe all 11 of these people are serious. I would, however, love to see David Zervos as the Fed chair. He'd be the Fed chair with the longest hair since the history of the Federal Reserve since 1913. So that would be at least something to talk about.
That is true, and perhaps the most facial hair in a while as well. Steve Leisman, is this perhaps that situation that a lot of job seekers have become familiar with, where maybe the hiring folks already have a pretty good idea of who they have in mind, but they post the job anyway and make it look like there are a lot of potential candidates?
Yeah, there's some speculation that Scott Bessent pulls a Dick Cheney, which you may remember, John, was when he was interviewing for George Bush's vice presidential candidates and ended up picking himself. But I don't know if that's the case. You'll remember the president removed Bessent, or said Bessent had removed himself. What's interesting about that, John, is that somebody told me that it's not really Bessent's call to remove himself, that if the president wants Bessent to be Fed chair, that's entirely possible. I think the latest probabilities showed that, or the latest betting showed Waller being a leading candidate. That would be an interesting one. I think David's right. There are people who should be taken seriously on this list and people perhaps less seriously. And why they're on the list is unclear to me. Phil Jefferson is, I believe, not going to go out and change his very non-public demeanor and start writing positive op-eds about the Trump administration's economy or how he's going to cut rates apart from whatever the Fed chair, Jay Powell, wants. So it is interesting. I would say if I looked at that list, Zervos is a huge possibility. He's also, along with Jay Powell, have something in common. They've both been to Dead and Company shows, for what that is worth. Kevin Hassett and Kevin Warsh began as probably the two favorites. It's an interesting idea. I wonder what Wessel thinks of this, that the list has expanded beyond those two, suggesting that maybe the president is not happy with either of those two, or just having those two along with Waller on the list.
David Wessel, is it that, or perhaps that he's expanding the search beyond the chair to whoever he might nominate next?
Right. So I think Steve's right. I wouldn't rule out Scott Bessent as the guy who gets the job in the end. I think the other thing to think about here is the president's going to have a couple of opportunities to put people on the board of governors. There's the Kugler seat that he's filled temporarily with Steve Mirren. Presumably Jay Powell leaves. There's a seat there. And then there are other governors who may or may not stay. And so some of this may be trying people out for seats on the board of governors. If, for instance, Michael Barr decides to leave, or Chris Waller, if he doesn't become chair, decides to leave. So I think there's a lot of balls in the air here and a lot of trial balloons.
Shipping 10,000 packages of...
Okay. Holy smokes, Mitch. We have been talking for an hour and 20 minutes, so we are running behind. But what do you think about those candidates, and are any of them being used as propaganda to push more pressure on Jerome Powell to do aggressive rate cuts? What do you think?
The law of unintended consequences is the ramification of the Federal Reserve. So cutting interest rates would be a sign that what we already know, that the economy is in trouble. The Fed is a creation of the U.S. Senate, which occurred in 1913. In other words, the U.S. Senate created the Federal Reserve, and the U.S. Senate can terminate the Federal Reserve. That is the correct lever through which the administration should be dealing with the Fed's kabuki theater and the nonsense being spewed by these morons, that these talking heads that haven't got a clue what they're talking about. And why do they not know what they're talking about? Well, because cutting interest rates without addressing the fraud is an exercise in futility, in that any reduction in the debt load, even $500 billion a year, is going to be offset by the compound cumulative interest because they didn't address the fraud. The point of the matter is it's all kabuki theater. You either address this fraud or everything you are doing is a complete waste of time. Look at the compound interest calculator, and that's your proof.
Okay, very good, very good. All right, we're going to move on. I want to get to the game is rigged, which is going to be the last segment. But a couple things. I wanted to give a shout out. I wanted to give a thank you to Median, because Median actually did a write-up of one of the live streams that Mitch and I did. So this is a shout out to them. If you guys want to check out Median, the link to this article is in the description of this video. So I mean, he really broke this down. And again, this is on a live. So this man had to listen, or woman had to listen to an hour, hour and a half. He's going into what we're covering: tapped out consumers, retail inefficiency, the burden of property taxes, fraudulent government practices. Big shout out to him. Again, you guys check this out. I just wanted to read a couple things here. The Creator's Lens, again, talking about real estate mindset's call for systemic change. The Real Estate Mindset channel, spearheaded by Travis Spencer, approaches these economic issues from a perspective rooted in the real estate sector. Their association with, shout out to Mitch, Mockingbird Properties suggests this is to you, Mitch, a deep understanding of property markets and the financial pressures on commercial entities. It is this background that likely informs their strong emphasis on property taxes and a significant contributor to the retail meltdown. And then you're also saying I have to put this disclosure on YouTube right here because I'm not a financial advisor. I don't want that liability, and I'm also not collecting your money. So why would I have that liability? But they're going on to say, however, their willingness to challenge conventional narratives and pinpoint systemic government issues provides a distinct and often thought-provoking viewpoint. Thank you so much, sir, for that. You have no idea how hard we try to create that engagement, to create content that gets you guys to think. It's so important to us. The current state of retail is undoubtedly a multifaceted crisis impacting countless lives and reshaping communities. While consumer behavior and technological advancements play undeniable roles, the Real Estate Mindset video compiles a deeper look into the broader economic policies and their profound, often overlooked impact on industries like retail. Their focus on property taxes and critiques of monetary policies spark a crucial discussion about the fundamental structure of our economy and the systemic changes that may be necessary to navigate the turbulent period. I mean, this is a great write-up. I'm super happy that they're getting it. As store closures continue and layoffs mount, the call for innovative and perhaps unconventional solutions, it's not even unconventional, it's like just follow the law, grows louder, challenging us to consider every angle in the pursuit of economic stability. So great write-up. Show these people some love. Mitch, before we go into the game is rigged, I want to pull up these comments real quick from Ryan. Okay, because Ryan wanted to know a few times, and I wanted to make sure not to forget him. He's asking for an update on repealing property taxes with an emphasis on hearing back from the DOJ. Can you give them an update, please?
I did hear back from the DOJ. They said send it off to the FBI. Over and above that, which we did, and that all this information. So every time a document gets created from any entity that comes in, i.e. a government entity, everything we are doing is posted on mockingbirdproperties.com/DCAT. Their comments to me, my comments back, everything that's going on Travis's channel, everything that's going on Jeff Mashburn's channel, these are addressed almost on a daily basis. And to that point, although we haven't addressed all the articles that I've written in the last week to 10 days, if you go to mockingbirdproperties.com/DCAD, you will see 6 or 7 new articles. Just type in the word articles on the search bar, because the entire site is now searchable. So you can search for anything you want to see. It's all there. What we're working on now, that I'll be doing yesterday, today, Saturday, and Sunday, is creating something for the benefit of the FBI locally in Houston. And we hope to be with them probably within the next 10 days or so. And that'll be a map. And the map will be linked to the very hardcore documents so that all the viewers can see the same thing that the FBI sees, that leads to the pure criminality of what they did, how they did it, who did it, what the ramifications are. So I'm in the process of getting that built right now.
Okay, very good. Before we go into the game is rigged, we got Luke here with Market Mania. Luke and I are going to do a video, I think, in about half an hour. Luke, what's going on, man? How are you doing?
Yeah, doing good. How are you doing?
I'm doing fantastic, Luke. Happy Friday, sir. So what are you seeing in the economy right now? You want to share a little bit of your insights?
Well, the Canadian economy does not look healthy at all, and it comes with an economy that's dependent on a housing market like Canada's has been. And I was just actually watching our video, Mitch, that we did together last year, because I was trying to educate myself more on what's going on with the ARB, and I know that you have US PAP in the US, and we have US PAP in Canada. And basically, I was going through all these Reddit threads where people were complaining that they got their assessments back for their property taxes, and it was like way higher. And then people are going in and some of them are getting them adjusted down, others are having no luck. Like they're saying they have basement suites when they don't. Like it seems like it's just all made up and fraudulent.
Yeah. Very well said, sir. So you ready for, okay, so let me ask you this question. We're going to get to the game is rigged. What's your biggest concern right now, Luke, with the world economy? I know you have your hand to the pulse of just the world economy. So what do you think is what we should, what do the one thing we should be the most aware of that's happening behind the scenes?
Yeah, I think when you look at the economy as a whole, the global economy is slowing down. And the main reason for that is just that this recession that has been kicked down the road for so long. I mean, during the pandemic, there was an unbelievable amount of credit creation, money printing, if you want to call it. And basically, in all Western economies, you've seen this has just been kicked down the road. Like we've been long overdue a major recession in the United States, in Canada, in the UK, in Europe. And it's funny because what I want people to realize is when you look at the media, and I see this from all angles because I'm always looking at global stuff, is the way they report, oh, it's the tariffs that are causing this, or, oh, it's Canada-US relations. That's the reason why tourism is down. I mean, tourism is a leading indicator of what the consumer is feeling. And you look like it's not just US Canada boarding crossings and that BS. If you look at it, it's down in Europe, it's down globally. Mexico is feeling it as well. So people are cutting back. And what that means is essentially recession. And it's a global one because just look at all the tourism stats.
Do you have a response or rebuttal, Mitch, to what Luke said?
Well, fellow Canadian, eh? So he's right. Yeah, it's clear. Like I said, nobody knows what canary in the coal mine is going to die first. London is hemorrhaging. Germany is hemorrhaging. Germany is probably in worse condition than anything else. But nonetheless, you get, even from there, a compound cumulative effect, because once one of them goes off the edge, everybody else will follow because it's all interconnected. Your global supplies are interconnected.
Very good. Very good. So, Mitch, let's move on. And Luke, maybe you can comment to this. Mitch made a really good, excuse me, I'm getting choked up here. Mitch made, where'd Luke go? Luke, where are you at, man?
I don't know.
There you are.
There I am.
Okay. Mitch made this article really good. It's called "The Game is Rigged," aka Your Life. And Mitch, do you have that up on your screen? Are you ready to read this in? It's only 3 pages. Are you ready?
Yeah.
Okay. Whenever you're ready, I'll go ahead and follow along on the screen.
This is one more article in a series that builds upon each other and allows my thought process to become more direct, with the goal of helping distill the issues in bite-sized elements of understanding of both the micro and macro picture of the debt and taxes mandated to support that debt. After more than 35 years of doing what I do, one thing is absolute, and that is truth doesn't sell, but it saves you if you're willing to adhere to it. Liquidity dries up, sentiment reverses, price discovery returns like a sledgehammer swung by the comedian George Carlin. Rising debt levels at state, school district, federal, and personal, as well as the real estate taxes necessary to feed the interest on those rising debt levels, including outstanding fraudulent school district bond debt, raise nightmarish concerns. However, the problem of rising debt levels is option A, default, or option B, a continued degrading of economic growth, which without immediate course correction has a very high probability of leading back to option A, being default. Regardless of state, federal, school district, corporate, or individual, debt is debt. And one should know if that debt is productive or non-productive debt. Let's consider at the state and federal levels increases in debt under which there would be little to no economic growth. This is because all government debt winds up in the economy and the household's balance sheet through lending, credit, or direct payments. We know this by looking at the dollars of debt required to create a dollar of economic growth. So in this article, which will be below Travis's video here, is going to be a link, and inside this article are links to additional documents that back up what we're saying here. The problem with the current issuance of debt at both the federal and school district levels are that it is non-productive debt. As I have stated in multiple videos, one must understand how to handle debt, and most people do not. They do not know how insidious the manipulation of becoming an economy or person based on the purchases truly is. Productive debt refers to borrowing used for investments that generate long-term economic returns. That's productive debt, such as infrastructure, research, or business capital expenditures, and on a personal level, one's education. These types of investments ultimately pay for themselves and deliver a yield on that investment. Hold on one second.
Oh, take your time. I got lost, but I found us.
The non-productive debt funds consumption or transfers that due to not yield a measurable economic return. So the non-productive debt does not yield an economic return, usually. In the US, social welfare and interest payments on the existing debt are such non-productive debt as roughly the $5.1 trillion in outstanding fraudulent school district bond debt, from which property taxes are being used to pay the interest and not pay down the debt. Compound, cumulative, roll up the debt and roll out the interest. Another way to think about it is that this is the definition of a Ponzi scheme: non-productive debt plus interest on that debt. The data shows that of every dollar spent by the federal government, roughly 73% is mandatory spending on social welfare and interest expense, not to mention the $1.8 trillion deficit in 2024 on the US national debt, and this does not include the unfunded liabilities. There is no disagreement about the need for government spending. The disagreement is with the abuse and the waste of it. It is the politicians who allowed for the demand of the unjustified social spending, as it is the banks and those invested in the US treasuries that receive the yield on those funds lent. However, as I've stated, the higher the risk, the higher the required rate of return for the dollars loaned on the investment. Just because the Federal Reserve may drop the interest rates 0.25 basis points or 25 bips does not mean that the lenders will follow suit, and does not mean there will be a measurable difference to mom and pop at any level. If the Federal Reserve over, say, the next 12 months dropped interest rates by 200 bips, which is 2%, that might start to have an effect. Except, what does that say about the economy? Spending must be designed to raise productive capacity, potential growth, and return on investment in a measurable form. The data below shows that every dollar spent by the federal government, roughly 73%, is mandatory. The rest of it isn't. Increasing real gross domestic product to 4% annually would vastly improve the current predicament. If interest rates drop by just 1%, this could reduce the federal spending by $500 billion annually, helping to ease fiscal pressures. But stability and long-term legal measures to maintain that stability are paramount. Just because you can achieve it, if you don't put a cap on it and say we can never get here again, you are wasting time. It's an exercise in futility. Forced debt reduction via bankruptcy in a very specific area, school districts, is the solution for roughly $5.1 trillion of outstanding fraudulent school district bond debt. That specific circumstance as the potential is not economically damaging to society, but would ensure the return of the balance sheet to mom and pop, such that all property owners own the land beneath their asset, thus ensuring the economic engine, being the citizens of the United States, are able to attain the American dream of home ownership. Underneath the articles that we just produced this week is a whole new section on documents written by Thomas Paine. One of the quotes that he wrote is, "The greatest tyrannies are always perpetuated in the name of the noblest causes." The other one is, "It is the duty of every man, as far as his ability extends, to detect and expose delusion and error." That's it.
Very good. Very good. Real quick, Luke, I wanted to pull up your channel just so everyone, can you explain, and great workup, by the way, Mitch.
Thank you.
If you want to respond, Luke, to what he just said, that would be good. But I'm also pulling up your channel. So do you have any response to Mitch?
So Mitch, in the 1980s, that time frame, does that line up with wealth inequality, like blowing out massively as well, which you used in that paper?
Yes, they're directly correlated. So as the debt climbs, the actual inverse is occurring. So the debt can be seen in the compound interest calculator. So that's climbing. The US national debt is climbing, but the quality of life is actually decreasing. The quality of home ownership, the actual number of people that are 30 years of age or younger owning a house, has actually fallen to the bottom right of the chart. In other words, they're not able to buy anything. So these things are 100% directly correlated. The higher the debt, the less the quality of life, and thus the less the American standard of living. And thus the ability, the American dream of home ownership is simply being destroyed. It's being eaten by the debt.
Okay, I have good news and bad news. The good news is that was a great answer. The bad news is your picture froze, but your audio is good. Last thing, Luke, will you explain? I know, it's like, oh my God, but he's still talking, so it's great. You did great, man. I don't know why it's froze. But if you guys that are watching, go to Market Mania. Luke covers a wide variety of topics. He's the man on the other side, not the other side, but he's across the world. Can you explain before we go, Luke, what your channel is all about? Again, this is Market Mania. What is your channel all about, buddy?
Yeah, so it's all about freedom and liberty at the core. And why I really created this channel back in 2021 was just because I was so angry with what was happening in 2021. And as many people had that frustration of what was happening to asset prices, and it just didn't seem real. And that's why I called the channel Market Mania. And I pretty much was just calling out the Canadian housing bubble, which has a lot of similarities to the US housing bubble in 2008. And I've drawn those comparisons many times on my channel. You can search the videos and find those because it's quite interesting. I always think, and I'm always looking at other countries to figure out, are there any similarities? Because there are other countries with bubbles, the United States, New Zealand, Australia. So I always think it's great to compare like that. And really, it's just my passion. Like, I love diving into these things deeper and looking into these things and seeing what I can find out. And now the Canadian housing market is really crashing in certain areas. Like Toronto, home prices have gone down significantly. And if you adjust for inflation, I mean, it's absolutely unbelievable the amount of losses that we're seeing. And I do videos covering those as well because everybody refuses to call it a housing crash. It's like they'll probably call it after, in hindsight, a housing crash. But right now it's like, no, it's just a correction.
Yeah. Well said. Mitch, are you still there or are you frozen? Can you hear us? Can you take yourself off mute? I know that you're
I'm here.
Okay. Now, okay. So this is the perfect last comment from Stephen Hill. We were trying to warn you guys about people like Stephen in the beginning of this because they don't know what they're talking about. So, and this is not just Stephen. I think this is good to bring this up because the people that are following along need to be able to rebuttal just the bare minimum resistance with no thought put into it. So Stephen is like, yes, cut property tax on landlords and make everyone pay the tax, including the poor. You guys are typical. And Stephen, I got to say, your apathy and lack of knowledge is also typical. And look at, here it is. See, sales tax will be 20%. So there's rumors going around like we have to have 20 to 25%. So this type of attitude is dangerous. This type of propaganda is dangerous. If people really care about the poor and what they're paying, they would look under the hood and understand that there's senior citizens, widows, elderly people with they're being kicked out right now because of property taxes, and it's against the 16th Amendment of the Constitution. So Stephen, wake up, brother, and do the math. If you want to make a difference, you have to know what's going on under the hood, or you're just a fool. And so stop being a fool and spreading around your nonsense. And the thing is, it's not just Stephen's fault. He's a puppet off of what someone else is saying. And that's why I was like, who's saying it? And is it that, what is it, Button Corp? Button Corp, right? Button Corp came out with some of that 20, 25%.
Yeah, that's where it started.
So that's what I'm saying. It's not only Stephen that's doing it. He's obviously letting someone else think for him because he's not going into the math. But again, can you just reiterate, Mitch, how it's not 20%? It doesn't adversely affect the poor. They're using that as propaganda to make you give up on fighting property taxes. So, Stephen, I'm not saying that you're a bad person. I'm just saying it's a foolish comment and that we need you on our side to wake up. So, again, come look at the math. We have bills in Texas Ledge showing the math. What again, and this sucks, Stephen, because you're part of the community and we need you and we love you. But we need people to wake up. It's not 20%. Wake up. Mitch, do you want to, but isn't that funny? We ended the same way we started, right? With that 20%. And another thing, Button Corp, Stephen, Button Corp has a tax protest company, he makes millions of dollars. So it's in his best financial favor to continue property taxes. Just FYI, if that's where you got that. Mitch, any comments there?
I don't know of any other source in the United States that has more information available to the public for free, documenting every stitch of the math behind the scenes, including answering the question as to what the sales tax will be, other than mockingbirdproperties.com/DCAD, other than Travis's site, and other than Jeff Mashburn's site. The evidence is irrefutable. Over and above that, I would defy literally anybody prove anything that is wrong on those 3 websites. We have gone to extraordinary lengths to make damn sure that whatever we're saying is backed up. It's quantified. It's quantified in law. It's quantified in math. And the bottom line is, as far as we know, I keep asking people, if there's something wrong, we'll change it. So far, out of well over 6 million views in the last 120 days, crickets. There is no excuse. These people are caught. These criminals are caught. The laws have been broken. And if people like Stephen, listen, bud, I'm sorry, but you're dead nuts wrong. And your arrogance is showing. And frankly, I don't have the time or the patience to get involved with somebody whose common sense is non-existent. I may as well have a conversation with a brick.
Well, I get that part too, but it's like, and I'm sorry it was a little bit of tough love, but we got to be gentle with people, brother, because they want to change, right?
Absolutely.
New budget with school.
No problem. Happy to speak with them, but you got to understand, go read before you talk. Go learn before you talk.
I know. But I don't want to push anyone away either. I mean, imagine
Absolutely
someone
not.
like,
I don't want to push them away. No, I want
and
them
I
there.
know
That's perfectly fine, but learn.
And learn, right? And I want to reiterate that. So it's not, it's all important. And imagine someone like Steven who came in throwing up on everyone, throwing around his assumptions. Imagine him learning, seeing what we're saying is true, and then jumping on board. It's sometimes those people are the strongest advocates because they want to do something. It's just they're looking at the wrong thing, or they're listening, because a lot of people still think they can trust their government. He's one of those people, especially if Bancorp is the one that said that. And then people take what he's saying because he's a senator, and then they post it on social media like YouTube, and then that spreads. So it's important that Stephen talks. It's important that these people that have that preconceived notion talks, and that we're able to talk and not push people away. And I shouldn't have said any name calling. It's just frustrating because we literally have 1,000 documents contrary to what he's saying. So there's that first, like, I'm going to get defensive. You're not listening. But the reality is like Stephen is the exact people that we need to understand what's going on. We literally need people just like Stephen to go under the hood to make a difference. We can't do it without people like Stephen. Most people are like Stephen. And so we have to figure out many, many ways to help people down that path. And that's why I think that the FBI meeting that we're going to have, Mitch, when we take the body of work that especially you've been working on and we dumb that down to a 5-year-old and then turn that into the FBI, that's going to help everyone. But the politicians are really maniacal, I would say. And it's so crazy that your picture's frozen still.
This is the United States of America. And here in the United States of America, everybody has a First Amendment right to say what it is they want to say. But that doesn't mean that they're right? When the evidence is in your face, literally, it's sitting there in documents, it is very important. Go and read that evidence. You can still have your opinion. You can agree to disagree. Reasonable people can do that. What you can't do is spout nonsense that in truth is harmful to yourself, your family, and your neighbors. That's not acceptable. So say what you want, but please study. People have spent, the truth of the matter is what we've got on that website couldn't be done but for spending massive amounts of money. How much money did anybody else spend in their comments that are not based on fact?
I mean, you're not wrong. You're 100% right. But I feel like also we're leveled up. And here's a comment from Coyote of SC. They're like, Travis, don't excuse people being willfully ignorant. I'm trying to be patient. I'm trying to be humble, and I'm trying be gentle. And the thing is, was like Steven that made that comment, he's one of us, man. He's a mom and pop, I believe, right? And maybe he's a bot. Like, screw you if you are, right? Maybe he's part of government. Screw you. But I don't want to fight victims. And I look at someone that makes a comment like that as a victim, and I don't want to fight him, man. I want him to join us. And so I think that there's a little tough love needed, but just a little bit. And then a gentle approach, I think, is what has been on my heart. Because he is our family, and I mean, Steven's our family. He's in the community. If he's not a part of the government, if he's not pushing the fraud, he's a family member, and he's just indoctrinated. And so we got to figure out ways to help these people, not push them away. Would you agree?
Like I said, everybody's entitled to their opinion. I just want to know where it's coming from. But
yeah,
please read, learn, and understand what's going on, because those comments are hurtful to yourself, your friends, and your family. These real estate taxes and the fraud associated with them is real. This is big money, and it's getting worse by the hour. It's getting worse by the nanosecond, just like the U.S. national debt clock.
Yeah,
that's the bottom line.
And I mean, he's, you know, this guy's, I mean, the big problem, so many people are not awake yet. And that's what my fear is, right? That's why a little tough love, yes. We got to keep everyone safe. But again, we got to be careful as well. Luke, I want to give you the last words. Mitch, I really appreciate you. Luke, last words here, and then obviously we'll move on to your channel. But any last words you want to give to the viewers?
No. I can't really think of it.
What? Nothing? Are you serious? Happy Friday, maybe?
Yeah. Happy Friday, guys. And yeah, I mean, the amount of fraud that's going on with property taxes is absolutely insane. And I see it everywhere. And it's not just happening in the United States, it's happening in Canada as well. And people do need to wake up about, because when people wake up and come together, that's when we can create real change.
Yeah, I agree. Mitch, anything else you want to say before we go?
Obviously, I'm from Canada, so I understand these problems. My engineer is in Canada still. I have family back there. It's hard to tell, but the bottom line is that Canada is a mirror image of what's happening in the United States, except it's in worse condition, because in truth, the vast majority of population is between Windsor, which is where I'm from, and Montreal. Yet the country's landmass is 1.5 times the size of the United States. And I've said since I was a kid that Canada really needs to become the 51st state. But with that said, nonetheless, they've got economic problems just like we do. It's just magnified because of the lack of population.
This got to be Les right here. What's up, Les? I see you. Man, I'm getting choked up. All right, guys, we're going to get you out of here. Happy Friday. Just this last little bit I want to tell you guys going into the weekend, understand that we are all in this together. Be a patriot. Stand up for your civil rights. If you guys see something wrong, understand you got to record it. If you don't record it, it doesn't exist and you will be made crazy. Fight for your rights. One of the things I want you guys to do is save as much money as possible. I know you're drowning in debt. Rebudget this weekend. Save $500 subscriptions going out to eat, whatever it is, and get more perspectives on what's really going on under the hood. Hopefully we provided that for you. Everything's going to be linked in the description. Everything's going to be chaptered. We got some good people on the channel. Thank you guys. I love you. Happy Friday. And if you're out there investing in real estate, you guys already know we wish you luck. There's Luke right there. He's trying to say bye, a little bit premature. It's okay. And we hope you win.